anything, they can all be done. All NFT, all certification for everything will be NFTs, because then you take it around with you. You've got authentication in seconds. You don't have to look for your old school certificate that you've stuffed in a drawer somewhere and you can't remember where it is. All of that becomes much easier to manage. Your life becomes much easier. You have one wallet, all your authentications are in there, and you can do all of that. And it, as I said before, it supercharges behavioral economics. So behavioral economics is basically gamification of the global economy. It's human incentives. It's basically psychology and behavioral sciences. And how you incentivize people is much easier when you've got a token-based system. Basically, that is not far off what Facebook did with the like button and stuff like that. Some of them, they're using emotion as the token, essentially. But basically, you can incentivize people to take certain action. Now, games have done this for years. That's why games have scaled so big that they're bigger than all other media added together, because of the behavioral incentives within the game. You get here, then you get that. You come here, and then you get that. Can you take it from one game to the other? Well, that comes down to blockchain. It's at every fundamental level of everything we do is human economic activity changes because of blockchain technology.
While most crypto app users worldwide lost money on their Bitcoin holdings after last year's collapses of the Terra ecosystem and the FTX exchange, investors outside of major economies took the biggest hit, the Bank for International Settlements said in a report published on Monday. Hello and welcome to Money Talks. In today's video, Real Vision CEO Raoul updates about his outlook for blockchain technology in 2023. Raoul also breaks down the benefits of regulations in the space and how it will drive the future of institutional adoption in crypto.
You've got a way of having a quantifiable bonus structure. There is also another thing that most companies have is the people who do particularly well are very in demand. So everybody wants more of their time. I think at some point we will just tokenize time. So if there's a HSBC token, and you happen to be the amazing IT person that everybody wants to use, well, you have to pay with tokens. And so you've got a free market in people's time. That becomes very powerful in allocation of resources, because if I go to that guy, and I don't have a pressing urgent need, but that guy's currently $200 an hour, I'm not going to go. I'm going to go to the other guy who's almost as good, but is trading at half the price. So you get an efficient allocation of resources within a corporation, and it happens at economic level overall as well. So there are so many ways that we haven't even started that we can do with the smart contracts and the tokens. And the smart contract is basically code that settles the contract, that tells you the rules of the contract and how it's settled. It's as simple as that. And that's why anything could be kind of stored on it. It's basically storing something on a blockchain.
Losing money in risky investments isn't exactly a new phenomenon. Last year, American investors lost $9 trillion due to falling stock prices alone. More than $450 billion vanished from the crypto market following the collapse of Terra in May 2022, and another $200 billion was lost following FTX's bankruptcy in November, the report said.
So if you're an investment bank, it's really straightforward. You are the gatekeeper to your clients, and everybody has to come through you. And occasionally you might hold dinner and get some clients together or an event, but that's it. So you don't have a network effect that others leverage. They have to go to you for that. Web3 enables distributed networks of people and people to be able to share in the success of that network. So imagine if Morgan Stanley had tokenized, and I've been speaking to an investment bank who's looking at doing this, a smaller investment bank, boutique investment bank, who've tokenized their clients. And I'm looking at doing with the Exponential Age Asset Management to create a token around our clients. So now your clients and you share in the success, because the value of a network is driven by the number of connections between the people on the network and the number of people on the network. So if Morgan Stanley were to have a Morgan Stanley token, and that token is your access to the Morgan Stanley world, but not just via the salespeople, or the websites, but actually to the other customers themselves. Now, what could you do? What value could you create without the need of the investment bank in the middle? But the investment bank still gets fees because the network value goes up, or maybe they take, every time there's a transaction, a small part. But imagine how disruptive that is to having salespeople or M&A bankers or any of that stuff, when a client at one end can speak directly to the other. They're on the Morgan Stanley platform. They're authenticated. They are who they are. And so now they can network with each other in a way that you can only do at these big giant events, which investment banks love to be controlling over. You know, who's talking to. What you allow is that freedom of information, exchange of ideas, and the leveraging of a network. That makes it very valuable to join that network. So Morgan Stanley creates a tangible asset out of an intangible. The intangible is they got a bunch of really good clients that can do business. The tangible, and a salesperson knows if I get these clients together, they'll probably do more business than if I keep them apart. But investment banks don't think that way. They want to keep everybody separate, don't speak to each other. Same with asset management firms. But actually, if you put people together and say, you're now a participant in this network, then all that economic activity on the network drives the value of the network higher. So everybody benefits, the bank and the customers, and everyone has a value for being part of that network.
The report also said larger investors might have benefited at the expense of smaller ones. The price pattern suggests that larger investors were able to sell their assets to smaller ones before the steep price decline, it said. Following the market collapse, regulators who were previously more concerned about crypto's impact on financial stability have pivoted to setting up stronger safeguards for retail investors.
So it's much the same as, as clubs. You buy a membership to a club only for the fact that you want to meet the other people in the club and use the facilities. Now, club memberships don't go up in value, generally speaking, apart from gated golf clubs and stuff like that where there's a limited supply. They don't go up in value because none of the benefits accrue to the club itself. They just get the people coming in, buying drinks and paying for subscriptions. But if the club were to participate in the economic benefits that getting all those people together creates, then it's worth a lot more money. It's a really simple concept behind Web3, which is an alignment of interest and a removal of middlemen at the center of everything. Doesn't mean they don't play a role. They can be the facilitators, the organizers, the creators of ideas, the synthesizers. But if you allow the network to operate itself, it's like in the old days, you used to have to phone, before my time, you used to call the operator and say, hey, put me through to Somi. And then we got phone numbers. And suddenly what happens? Business explodes because you can call everybody directly. And then it became even easier with the rise of mobile phones and all the information at your fingertips. These are just networks, typical Metcalfe's law network effects. And the value that accrues goes exponential because there's all of the people working for the network to make it valuable. So another classic example is Facebook. So Facebook is a classic Web 2 story, which is they provide you the utility of being able to connect with people, sell stuff, do whatever you want on their network. They own the network, the shareholders own the network, and then they monetize you as you use the network, ads, other fees. Now, Facebook was a very powerful business and still remains so to this day. But imagine if the shareholders got rich and everybody else got taken advantage of, really. But they got the utility. That was the trade-off. Imagine if Facebook had given every single user shares in Facebook. Imagine what that would have done to that company. It would have been easily the world's largest company because you are now a shareholder. We've seen this with governments, right? When I was young in the UK, we privatized British Telecom. And privatizing British Telecom was a way to give economic participation that generated both economic benefits for government, the company itself, and the people. So, these are not new concepts. Tokenization just makes it really easy to authenticate. If you think of a share, it's really difficult to authenticate. I don't have a share certificate. How do you authenticate who you are, what you are, how you belong to the Berkshire Hathaway shareholders doesn't work. But tokenization allows that instantaneously because it can become your identity. So your Morgan Stanley token can be your Morgan Stanley token, and that gives you access to everything in the Morgan Stanley world, much like you'll have a client ID. But it allows you to move elsewhere with that without giving up your Morgan Stanley details, because maybe Soho House want to take Morgan Stanley people. And they say, well, if you've got a token, you get discounted membership. Okay, now you're leveraging other people's networks. As opposed to giving your client identifier at Morgan Stanley, we can't verify it, but a token you can verify. So there's so many ways of which it becomes your digital ID, it creates the network effects, and then you've got the smart contract element, which is every single thing we as humans do is contractual. Every single thing, including this. Society functions by contracts. Verbal, understood, explicit, implicit, explicit, and written, all sorts of different ways. Now, all of those, if we go to the investment banking industry, every derivative contract, every OTC derivative contract is vaguely unique. Yes, sure, it might be a swap, but it might have certain terms, or it could be an option. That is a contract. It's a unique contract. Now, right now, it's a nightmare to settle all of this stuff, to understand who owns what, to sweep the collateral, to figure out anything that happens within the whole ecosystem. It's opaque. There's all these ISDA complications. How do you sign the ISDA? Banks have backlogs of ISDAs. It's all a mess. Now, yes, some of it's gone to centralized exchanges, but you can do all of this on a smart contract. So I can buy from Morgan Stanley a call option on the euro. I don't have to sell it back to their desk. I can sell it back to Deutsche Bank, because in that contract is the code of what it is. And if it pays out, it pays out. So it's, everything, insurance contracts, ticketing, almost every form of digital identification. Your driver's license is a contract. Your passport is a contract. They're all contracts. And it's so much more efficient to have these that instantaneously settle and are verified by a distributed network, because therefore you can't have bad actors as easily.
So, what do you think about the Web3 future? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.